Hello, everyone. My name is Zulfiqar, and welcome to another episode of Income Investors. With me today is John Whitefoot. But before I go into any details, I want to let you know that anything you hear in this video is for information and educational purposes only. Nothing in this video should be taken as personalized investing advice. Investing comes with risk. To read more about it, please see the description below. The retail real estate investment trust sector, REITs for short, took a big hit during the pandemic. Not a big surprise. Quarantine ordered millions of people to stay at home, shuttered doors of tens of thousands of businesses, obviously not ideal for REITs that generate income through rent. One REIT through all of this has fared well, better than the most, is Simon Property Group. They're traded on New York Stock Exchange and their symbol SPG. John, do you want to explain a little bit what's happening here?
Yeah, thanks, Mo. Before I get into what Simon Property does, I wanted to point out that in 2019, the last glorious year before the pandemic, Simon posted industry-leading record results, which included revenue of $5.75 billion, cash flow of $4.04 billion, and funds from operation of $4.39 billion. It also paid an annual dividend of $8.30. Unfortunately, Simon Property suffered during the pandemic, much like everyone else. Since then, though, the company's revenue, funds from operation have come storming back, and so too is its dividend, share repurchases, and share price. Thanks to its well-located real estate and top-tier tenants, it bounced back in 2021 with significant occupancy gains and record retail sales. Full year revenue increased more than 8% to $5.12 billion. Net income was up 102% at $2.2 billion. It also reported record funds from operation, which were up 38% at $4.5 billion. While funds from operations per share was up 31% at $11.94. And this allowed the company to return approximately $2.7 billion to shareholders. It did equally well in 2022, and it looks like it's going to do better in 2023.
Why is Simon Property doing so well at a time, when retail REITs are struggling? And overall retail sector, we're hearing a lot about, mall closures and everything around it. What's happening here?
Well, with Simon Property, it's all about who you surround yourself with. Simon Property Group is a REIT that buys premier shopping, dining, entertainment, and mixed-use destinations across North America, Europe, and Asia. And it's grown massively over the decades. In 1993, its portfolio consisted of 114 properties, primarily middle-market malls in the Midwest United States. Today, Simon's portfolio includes over 250 properties across platforms in 37 states and 14 countries. For some people watching in the US, some of its properties here include the Shops at Crystals in Las Vegas, Nevada. It's the only all-luxury shopping destination in the US. Sawgrass Mills in Sunrise, Florida, is the Sunshine State's largest outlet value retail and entertainment destination. And Woodbury Common Premium Outlet in Central Valley, New York, is a shopping destination with 250 well-known global retail brands. It's always growing. It recently completed 14 redevelopment projects across all its platforms in the US in 2022. It opened 44 anchor specialty tenants in 2022 and expects to open more than 40 in 2023. Its global properties are anchored by 3,000 brands, powerhouses, including Gucci, Louis Vuitton, Apple, Hermes, Tiffany, and Giorgio Armani. In addition to its premium retail spaces, the company's growing portfolio includes office spaces, hotel, residential, and partner outlets. Over the last several years, it has added over 4,200 hotel and residential units to its portfolio. Again, it's a massive company. It's got its fingers everywhere. It also owns an 80% non-controlling interest in the Toberman Realty Group, or TRG, which has an interest in 24 regional, super regional, and outlet malls in the US and 4 malls in Asia. On top of that, it owns a 22.4% equity stake in Paris, France-based Klépierre SA, or Klépierre. It's Europe's second largest publicly traded mall operator, which owns more than 130 properties in 14 European countries.
I saw that this REIT reported strong Q1 results, increases guidance for 2023, and raises dividend.
Yes, to all three. For the first quarter, ended March 31st, Simon announced that revenue increased more than 4% year over year to $1.35 billion. Net income was up 6% at $451.8 million, or $1.38 per share. The funds from operation was up slightly at a $1.02 billion, or $2.74 per share. On the bodes well for the future because occupancy rates across the company's portfolio improved to 94.4%, up from 93.3%. Base minimum rent per square foot also increased 3.1% to $55.84. And you might feel sorry for the retailers because the increased rent, but you shouldn't. Retailers can afford the hike. Sales per square foot improved 3.3% for the trailing 12 months to $759 per square foot. This comes on the heels of the fact that during the quarter, the company started construction on a 338,000 square foot upscale outlet mall located in Jenkins, which is near Tulsa, Oklahoma, and that's projected to open in the fall of 2024. Construction also continues on numerous redevelopment and expansion projects across North America, Europe, and Asia. And during the second quarter of 2023, Simon opened a designer outlet mall in Normandy, France. The center includes 228,000 square feet of luxury and premium brands. Simon actually owns a 74% interest in this center. So there's lots of good things going on, which bodes well, again, for the company's earnings going forward.
And what's happening with dividends here? I assume they're doing well as well?
Yeah. Simon is known for creating value for shareholders since going public in September 1993. Simon has paid more than $39 billion in dividends. In 2022 alone, the report returned $2.8 billion to shareholders, and that included $2.6 billion in dividends and $180 million in share buybacks. Again, going back to its 1993 IPO, from then through to 2022, Simon Group's common stock provided a total return to shareholders of approximately 2,400%, or a common annual return of approximately 12%. Most recently in May, the company's board announced it raised its quarterly dividend by 15 cents, or 8.8% year over year, to $1.85 per share, or $7.40 per share on an annual basis, for a current yield of 6.56%. Put that into perspective, the U.S. inflation rate is at 4.0%. It also has a history of raising its dividend. Admittedly, it did cut it during the pandemic, but it raised it for 7 of the last 9 quarters. And there's every reason to believe it will raise it again over the coming quarters. Simon's dividend is well covered with a payout ratio of less than 60%, and that's well below the 90% threshold that I think we're willing to stomach.
And what's happening with Simon's stock?
As for its stock, it's down from its November 2021 highs of $154.51 at around $113. But that can be attributed more to investor concerns about inflation, rising interest rates, and the long-promised recession. Still, Simon Property Group stock is mostly in the black, up 10.5% over the last month, up 27% year over year. That said, it is down less than 1% year to date, but that's pretty minor in the grand scheme of things. And the outlook for Simon Property remains bullish, with Wall Street analysts providing a 12-month share price projection of $130 per share to $160 per share.
All right, John, thank you so much for talking about Simon Property Group, traded on New York Stock Exchange under symbol SPG. Simon Property Group is the largest mall REIT, managing one of the top retail property portfolios in the US and internationally. It has been reporting strong financial results, has very strong balance sheet, one of the top in the industry. It's raised its full year guidance and has increased its dividend quarterly again. Thank you for watching. That's it for today. We'll be back with another video soon. In the meantime, don't forget to like this video and subscribe to our channel. Goodbye for now.